Good morning. Welcome to the show. Hope you're all well, despite, if you're in Hong Kong, of course, hope you're dry as you make your way into this rainy Wednesday morning across the Asia Pacific. As you can see, we're down about, 51% here on the regional benchmark. Although, as you can see, most stocks are actually on the way up right now. It's probably those heavyweights really weighing on the benchmark itself. Nikkei, ASX, as you can see, Taiwan's coming online 0.5%. To the upside, just a housekeeping point, of course, Thailand is closed today, and we just have flipped back into the positive as far as the Korean markets are concerned. We'll talk more about sort of, no big surprise, of course, the message coming through out of Jay Powell that they're in no rush to cut interest rates. What does it mean really for these rate differentials across the region with, you have, I think, the Banco Central is expected to cut as well. And then, of course, you have other central banks like the ECB, for example, as you look at the euro, for example. And we have DBS coming on later to put those two things together. And they're effectively saying we'll get to parity by mid-year on euro dollar. Right. Other things to note. Gold, as you can see, is paring back a little bit after we've seen just a substantial amount of money come in, whether that's some of your speculative flows, looking at CFTC long data, for example, just coming off a little bit as we approach the 3,000 level on gold futures and also gold spot. I should mention that. Okay, let's talk about the Alibaba story and some of the big moves we had overnight and, of course, that big drop that we had in Baidu. So certainly two stocks to watch on the AI theme on this reported tie-up between Alibaba and Apple. We'll talk more about that later. Certainly some stocks to watch, as I mentioned here. Hon Hai Group getting a fairly big contract supplying LiDAR technology to BYD and 10 models there. So we'll look at what happens with BYD later on. We also had some car sales numbers coming through out of the PCA, the Passenger Car Association, late yesterday. So we'll see a lot of these car makers in China drop overnight on the Golden Dragon Index 1.7% as you flip the boards, mirroring really the drop that we had in the pullback in equity markets yesterday. Futures are pointing to some upside right now. And yeah, Rebecca, we'll see if this sort of uptrend resumes as it pertains to Chinese equity markets.
Yeah, that's right. It is a little bit of a grim day in Hong Kong. Let's see whether or not that doesn't translate into markets today. But to your earlier point, about the Fed chair comments, Jay Powell told the Senate Banking Committee there's no need to rush to lower interest rates with the U.S. economy strong and, of course, the labour market not a source of significant inflationary pressure at the moment. Let's just take a listen.
With our policy stance now significantly less restrictive than it had been, and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. We know that reducing policy restraint too fast or too much could hinder progress on inflation.
And that was the message out of the Fed chair. Let's bring in Ben Luck, senior multi-asset strategist at State Street Global Markets, joining us right now. Good morning. Nice to see you. I mean, the lack of significant market reaction to what Powell had to say, just, I guess, in many ways tells us that markets are just used to, the message is already through as far as rates will probably remain where they are.
Yeah, I think it was well telegraphed. Market pricing wasn't a big surprise anyways running up to the meeting. And even if you look at market pricing from now towards the end of the year, markets are only expecting, I think, 30 to 35 bips in terms of a rate cut. So there's only one, if max, even just two. Our stance is actually no rate cuts this year from the Fed, given the fact that the labor market is still strong, the wage data is okay, earnings are still living up to expectations, and then the U.S. growth story or the U.S. exceptionalism story that everybody's talking about, that's still valid. I mean, although equity price actions have been a little weaker year to date, but we still like the story in terms of longing U.S. equities, at least for the levels that we're in right now.
Just to pick up on that point about U.S. exceptionalism, what are some of the early indicators that you might be looking for to sort of tell if that is starting to lag or there's starting to be a shift there?
Yeah, I think it all comes down to earnings at the end of the day. When you actually look at earnings expectation right now, the 2025 year-end EPS forecast is still around low double digit in terms of what analysts are expecting. That all comes down to whether or not we have these unknown trade tariffs that are still going to come through throughout this year in terms of the new administration, and whether or not margins are going to be impacted, whether or not overall earnings are going to decouple from what we've seen in previous years. For now, I think it's still okay, given that there's still a lot of uncertainty, no doubt, in terms of what's going to come. But just looking at the underlying balance sheet that we're seeing from many of the corporates in the U.S. is still very healthy. Operating margins are still quite high. It's still a reason why we should long the U.S.
Do I lean into Mag 7 still, or do I assume that broadens out?
Right. So for now, we're still leaning more towards Mag 7. The issue is the earnings go through this phase where it has to start off with obviously the large caps, and then obviously if interest rates slowly becomes more supportive of the real economy, then maybe it's going to broaden out into smaller caps or mid caps in general. That's not something we see yet, which is why I think most of the earnings right now is still driven by the Mag 7, and that's where we still like the most, at least within the U.S.
Outside of the US, where are your strongest conviction calls? How are you thinking about EM?
Right. So we are neutral EM still. I mean, there are pockets of opportunities that we like in particular because we're obviously long U.S. tech. The natural place that we also think works quite well with the U.S. exceptionalism would be places like Taiwan. So the Taiwanese tech space is an area that we like. We're not yet at an area that we're comfortable to go overweight China yet. We have obviously moved that back to a neutral last year. But in terms of us as a custody bank, we have the pleasure of obviously looking at many flows and in particular institutional flows. And really what we see is still very mild buying from institutional investors. There hasn't really been a surge or really a strong pickup in sentiment yet. So I think that's still something we need to wait and see. But at least we have actually moved back to a benchmark position, at least for China.
And to pick up on that, that's an important data point, that the lack of institutional money coming in to buy into this market that's up 20%. Do you think that's a good indicator to determine whether this is a tactical trade?
Exactly.
Or more than anything else?
Yeah, so I think the good news is, at least for now, what we are seeing is that positioning is very light already in terms of institutional investors. So they have been underweight for quite a number of years, basically since COVID. They have actually been underweight Chinese equities already. But whether or not it's a structural change, to your point, David, it really comes down to whether or not we see this periodic or persistent inflows to come in. And right now, we have maybe a week of inflow, maybe 2 days of outflows, a week of another inflows, but it's not really at a level where we think, okay, they're going to come and they're going to stay yet into the market. And that's what the first signal we need to see in order for us to really turn back into an overweight in the Chinese equity market.
To pick up, I mean, you needing to see something specific coming from the MPC. A lot of the discussion so far this year really has focused around the tariff risk. Which is more important in your mind?
I think it's going to be more on the NPC. To be honest, I think right now a lot of the tariffs that we're seeing it's not really selectively only targeting EM. I mean, the Trump administration could do much more in terms of what he could focus on. But right now, it's been more of sector-based, or maybe it's more on a focus on immigration as a tag-on towards tariffs. So I think what we are seeing is, as long as the NPC delivers in what hopes to be more of a consumption stimulus that we can see from China, and that obviously helps offset the export sectors, then that's already a good news in terms of a boost into the sentiment story that we were all hoping for, but still not there yet in terms of the China story.
You know, in the terms of that China story, some of the discussions I've seen online and I've had with investors is about how the role of DeepSeek might be changing thinking in Beijing. How do you kind of evaluate that in the context of the MPC? Do you think there's a risk or a chance that policymakers might be more inclined to double down on industrial policy rather than focusing on fiscal stimulus plans and consumer support plans?
So I think what we have actually looked at is we also managed to look at flows at the very beginning when the policy announcements were announced last year. And then we also looked into the flows basically since the DeepSeek announcement. And so far what we found is that, at least from the flow side, the momentum has actually been weaker relative to what we see from the policy aspect. So I think that is a signal for us that I think in order for the broader market to gain that momentum, it really starts off with the policy first. And it works really in conjunction. It's not just going to be a focus on fiscal. It needs to combine that with monetary. And really on the industrial side, as you've mentioned, really, it also can potentially come from more more deregulations in terms of the tech space, and that also helps in terms of driving those multiples higher if that sentiment really comes to starting to improve.
What about the opposite side to that same data point? Chinese institutional money, where is that being invested right now? Where are the flows from that specific source?
Right. So I think if we actually look at just within China, most of those flows, I would say, would be mostly really just targeted towards the CGB area. So, I mean, as the bond market still, what you see right now with yields basically at around 1.5 or even below that now, there's still this uncertainty whether or not this stimulus can really change the overall dynamic of the real economy. If those flows or if yields actually starts to pick up a little bit higher, then maybe that's actually a sign that you even see domestic investors moving a lot of the money slowly out of fixed income into basically equities. But for now, I think most of those flows remains to be largely concentrated in treasuries. Yeah.
I'm not sure how closely, as a final question, you guys look at gold. Right. Exceptionally well. Like, how do I need to be thinking about that if that is supposed to be a part of my portfolio?
Yeah, I mean, naturally, it's I would say the best safe or a hedge in terms of many multi-asset exposures in terms of portfolio. We don't exactly track gold per se in terms of our flows, but the fundamentals in terms of why gold has done well, I mean, real rates are still relatively low. I mean, obviously, the dollar hasn't actually performed what most people have been assuming in terms of the U.S. exceptionalism story. And really, I think what we also see is not just from institutional flows, but also central banks in general have also tried to enlarge their gold position as they rely less on dollar holdings or foreign exchange holdings as a way to basically diversify their portfolio. So I think longer term wise, it's still an asset class to consider, but there are going to be, hiccups in terms of whether or not that can be sustained throughout very short term. Given basically year to date, it's been one of the stellar performance already.
Yeah, 10+%.
Yeah.
There we go.
Okay. Ben, thank you so much. Ben Luck, Senior Multi-Asset Strategist at State Street Global Markets there. And just to cover some of the breaking news crossing our desk right now, SMIC, which of course did report earnings overnight, SMIC customers have placed rush orders on geopolitical tensions, again underscoring really the sort of self-sufficiency theme that we are seeing from Beijing when it comes to some of these key strategic areas of technology, Dave.
Yeah, absolutely. In fact, Morningstar will be joining us to help us unpack really the SMIC earnings story, and really the product mix and the customer mix is certainly something you want to watch as we go into, I guess, the next few quarters as it pertains to the story coming up, and roughly around the same theme, right? So we have a big company, of course, filing for this long-awaited listing here in Hong Kong, bottom of your screens, possibly paving the way for other large Chinese-listed companies to follow soon. Plus, of course, speaking of a trading debut today, Chinese bubble tea maker Choong is set to debut this hour. $230 million IPO. More on the listings ahead, and the CFO joins us at those times on your screens here on The China Show. Counting down to the open of trade, Shanghai, Shenzhen, and here in a rainy and gloomy Hong Kong Wednesday morning. The open is 16 minutes away. You're watching The China Show. Good morning.
Good morning to a very gloomy Hong Kong, Dave. But still, a packed day nonetheless. We have Choong, Hong Kong's debut IPO. We thought the bubble tea craze might have popped. It turns out it hasn't. We're back to market. We're also looking at SMIC. We have earnings overnight. We'll be joined by Morningstar analysts to help break down some of those results. And Vanke, a Chinese property developer, has been downgraded by Moody's. It's currently the only rating agency to have that name in that C range. It's highly speculative, highly risky category there. So we'll continue to look at those bonds. We also have reaction to the MSCI index changes. It's February deletions and additions. Some notable IPOs from the past year added there, including Tokyo Metro, Hyundai Motor India. And finally, we are also looking at the window for credit data, FDI coming in, loans aggregate, and so on. So just keep an eye out out for some of those key indicators about how the economy is doing. Dave, to his point earlier, we talked a little bit about gold and this rush into safer assets in the context of tariffs, in the context of potentially higher inflation, and another sort of commodity here that measures the economy, Dr. Copper. We'll be keeping an eye on all of that, really, today. Yeah, a very full
I'm a bit tired already. Yeah, should have stayed home.
But still, going back to that IPO story, we had battery maker CATL. It's filed its application for what could be this jumbo listing in Hong Kong, could be the city's biggest offering in 4 years. Let's bring in our China correspondent, Min Lo, to break down. What do we know so far?
Yeah, so the company hasn't revealed details of the scale and timeline of this listing, so it might be a little bit early to tell what demand would be like, but it's speculated to raise more than $5 billion, which will then make it the largest listing that Hong Kong has seen since 2021, when Kuaishou, the short video app, was listed back then. And this is a company that people are already familiar with. It's listed in Shenzhen, market value of about $150 billion. Its share prices, though, was down. You can see on the screen, down about 5% so far this year, but it was up last year by 68%, was performing very well, earnings as much as 20% increase, and on track to hit another peak in its annual net income. And this is a company that supplies most of the big players like Tesla, Stellantis, Volkswagen, accounting for about a third of global shipments when it comes to EV batteries. Its rival BYD is only accounting for less than half of that. So likely to see pretty solid demand, although remember that it has come under fire over US-China tensions. Has been listed on that Pentagon, the Department of Defense list of companies with alleged ties with the US military. So while that list doesn't carry any specific sanctions, it could have a psychological impact of preventing companies from wanting to work with this firm.
Yep, and sometimes that's more than enough. Min, thank you so much. Min Lo, our China correspondent there. So this is really just one of the companies, the biggest name here in this upcoming pipeline of IPOs and dual listings here in the city. Others are waiting to go public. Here include bubble tea maker, Mixue Bingcheng, Lala Tech, which is a parent of logistics platform Lala Move It. Really, those are expected to fuel this revival in Hong Kong's capital markets. The proceeds, in fact, from IPOs rose to more than $11 billion last year. And the folks at Bloomberg Intelligence actually extrapolate this figure to double this year in 2025 for a third straight year of improvement. That still would be, as you can see, though, visually still far below the peak that we had back in 2020.
Meanwhile, China's insatiable thirst for bubble tea has minted another billionaire. Ming makes its trading debut in Hong Kong on Wednesday after an IPO that raised more than $230 million. That values the stake held by its founder, Yun and Wang, at around $1 billion. Let's bring in Bloomberg's Asia wealth reporter, Felipe Pacheco, just to break down some of this. I mean, what are the sort of interesting highlights of this offering?
It's a very interesting deal, Rebecca, in many different aspects, let's say. We haven't had a bubble tea IPO in Hong Kong for nearly a year. It's a sector that we know that's been driving a lot of attention within China over the past few years. David just mentioned Mixue, which is another company that's also looking at the Hong Kong market to list. They're expected to come to market later this month. And then when you look exactly at the model of Ming, which is the one trading today, they actually started, and Wang himself opened the first shop nearly 15 years ago at focusing on second-tier cities in China. They didn't want to grow within the big centers, within Shanghai, Shenzhen, Beijing, where competition was already very fierce. But he wanted to somehow create a supply chain to allow freshly made tea to be sold in those smaller cities. You fast forward 15 years, and we have nearly 10,000 shops across China, 17 provinces. They have a model that is tries to differentiate themselves from the competitors. From that, and of course, well, it's paid off. He's near his 40s, and he's worth $1.2 billion US dollars right now. So it seems like it was a good idea.
No, not bad as you hit that milestone. Long on diabetes, as they say. I'm kidding there. Tell us more about the founder here.
Yeah, well, it's a very interesting story. He was just out of college, out of uni in 2010. He started working at a local, automobile shop, but that didn't last too long. He decided to open this first Ming shop in Zhejiang, just south of Shanghai. And slowly, the strategy of the firm was to just grow organically within provinces instead of trying to dominate the market in the country as quick as they could. This is what they said that they will keep doing from now on. Actually, Wang, the founder, and some of the directors that started with him back then, they are not selling their shares in the IPO. All of the proceeds that are being raised right now are going to the company for growth. And it is very important to point out that this is a very tough market, lots of competitors. We know what retail in China is at the moment, so it's not easy to sustain growth. And I think that this is the next question that we have for them, and the market will be asking, how are they going to keep it? How is this going to be done? And also, of course, companies that came to market over the past 2 years, 3 years, they're not doing well. Like the competitors are down a lot from the IPO price. So clearly, it's an interesting path for the company.
Felipe, thank you so much. Felipe Pacheco there. In the next hour, in fact, we'll be putting those questions to the CFO of the company following the market debut. We're up a little bit here in the first few minutes of trade here. We'll ask about the listing and also the longer-term prospects for the business. And as we count down 6 minutes away to the open, a look at futures pointing to the upside. SMIC, Alibaba, all up 3-4%. Plenty more ahead. This is Bloomberg.
Good morning. Here are some of these stocks that we are watching, stopping and starting, but watching all today, Dave, nonetheless. We'll start with China property here. Really, it's a downgrade story from Moody's. It's the only rating agency now to hold it in that C bracket. Stock actually just a touch higher. But of course, we did have the state shareholder stepping in to offer support.
Yeah, lots of that, plus some stories and some breaking news, in fact, out of SMIC. Baba, of course, is the Apple story. The open is next. This is Bloomberg.
Welcome back. Good morning. You are watching the China Show, and we are looking right now at these live pictures of the Ming IPO ceremony in Hong Kong. The aspiration is that it might bring back these bubble tea companies, of course, a really cutthroat industry in China, Dave. And we had seen the sort of long lag, and reports of regulators were wanting to pause and sort of cool down that market for a little bit. But anyway, yeah, really interesting to see this company come back to IPO.
Yeah, we'll go. $9.94 a pop was the IPO price. We're opening at about 10, as you can see on your screens. I think we're going to go back there to the open, just in case we want to see that proverbial or literal banging of Zigong.
5、4、3、2、1，枪！祝贺股民控股有限公司在香港交易所成功上市。
That will get you through your Wednesday morning blues.
That's usually, we should make this part of the show. We should get someone, it is the China show after all, right? We should get someone with a gong. Instead of a live band, I've always been pushing for a live band here in shows. I like that. Here we go. Long on diabetes. No, there are, of course, sugar-free options, right?
Yeah.
I was just walking, you know what? So I was actually off work yesterday, and I was walking through some of the streets of Hong Kong, right? And I literally passed, I would say, 3 or 4 bubble tea shops, within, I would say, 30, 50 meters, right? And it's interesting that Felipe Pacheco, who joined us earlier to talk us through this, as you look at the open, by the way, there's nothing much happening, so I'll talk about this instead. The fact that it's a big thing that we haven't had a bubble tea IPO in 12 months just tells you where we are really in the story, right? And these are traditionally businesses that normally didn't need to hit the capital markets for growth funding. but this is really where the sector is. Massive growth, massive competition, and it's interesting to see how they differentiate each other.
And Felipe also sort of noting this point that all of the capital raised from this IPO going into growth. And the company has had this sort of interesting strategy of focusing instead on sort of the hinterlands, these smaller second, third tier cities, really aggressive expansion, rather than some of the big, rather than a Shanghai or a Beijing.
Yeah. Was it 10,000 stores, I think, was
I think that's right.
Yeah. Okay. There we go. So just in case, the CFO will be joining us in about an hour's time to talk us through what they plan to do with the money and, of course, how they plan to differentiate themselves from the competition, given that, flip the page, please, to Hong Kong, given that most of their big competitors, and the biggest one, by the way, the bellwether, might also be looking to raise some money, are now all sitting on their own respective war chests. The bull market resumes here in Hong Kong, 1.2% to the upside. You have Tencent, of course, in the story there with Supercell and a nearly 80% gain. The other big story, of course, is Alibaba. And the other side, too, that same coin is Baidu coming up next on your screens just now. Baba's up 5%. Baidu was down materially overnight on the back of this report that Apple is choosing Baba and maybe not Baidu as it pertains to that sort of AI conversation and tie-up there. China Vanke is a moody story. Cut to those ratings and outlook negative for the stock, or for the bonds, rather. SMIC, okay, this is a big one. So they reported earnings. It's a miss on estimates. The outlook, though, was fairly strong. And you look at the wrap from analysts right now. They're talking us through the product mix, the client mix, as something as very indicative of strong demand ahead. In fact, just on that very note, we had that headline which crossed about 25 minutes back, talking us through SMIC seeing a rush of orders starting to come in. Zijin Mining's a gold story. Very, very quickly, the PCA, Passenger Car Association, out with some numbers on the January numbers. So year-on-year, very good. Month-on-month, not too much on NEVs. Plus 11% year-on-year. Month-on-month, bottom of your screens coming through as well. And just very quickly, a last check at this trading debut. 3 minutes into it being a public company, 2% to the upside. There we go.
And just for contrast, we've seen some of the other bubble tea names really as laggards, not just sort of in that sector, but more widely in the consumer space and in the China space as well. Anyway, back to that story. We were talking about this right at the top of the show, but recap of our top story. Fed Chair Jay Powell says the central bank doesn't need to rush to adjust interest rates. Let's bring in Taimur Baig, MD and Chief Global Economist at DBS Bank, just to break down the latest. Let's start with Treasuries. Not a huge surprise here. It does look like this was fairly well telegraphed already to the markets, but your take on Treasuries and where we are?
Still very complacent. I think that the market is sort of bewildered by the noise coming from Washington and is willing to give benefit of the doubt to the Trump administration that they somehow can go ahead with huge spending cuts, which will match the forthcoming tax cuts. And therefore, we shouldn't worry about the fiscal outlook. I think they're dead wrong. I think the U.S. will remain under a lot of fiscal pressure this year. And more importantly, the capacity of the market to absorb that large issuance is very suspect. So I would take any steepener trade over this flattening trend right now. I think this is one of those rare cases where the fixed income market, which is supposed to be the smart money, is dead wrong.
Okay, and it might have to do with some repositioning. To your point, this flattening we've seen in recent days. So what's the overall narrative then as we look at inflation, the outlook this year? Is disinflation continues, or are we sleeping on, to your point, potentially inflation rearing its ugly head at some point?
Even if Kamala Harris were the president today, I would worry about inflation. When we look at end 2024 data and whatever information we have about the first month of 2025, the U.S. is on the cusp of overheating. The GDP growth numbers are tracking 3%. Inflation surveys of companies which talk about their prices paid and prices received, all heading in the upward direction. There would have been worries about inflation even without discussions on tariff and immigration and tax cuts. And now we're going to add these three to this impending bottoming out of inflation. A substantial upside in my view.
If the data is that clear, do you think the Fed knows that? Do you think they're cognizant that their next move might actually be a rate hike?
The Fed is trying to do something that the Fed has never done before, which is orchestrate a cycle of rate cuts to prolong the cycle. A typical rate cut cycle is about, I see pipeline pressure on the labor market. I want to fight that by cutting rates. I see already evidence of recession. I'm going to fight that. This was none of that. September onward, they've been cutting to prolong a cycle where inflation is well over 2% and growth is close to 3%. So the last 4 or 5 months worth of steepening that we saw was not necessarily a reflection of the market not saying that we don't trust the Fed, but rather the market basically saying this is a different kind of Fed. Now, can the different kind of Fed live through the noise of the Trump administration and remain credible? I think is a big question. Can they sort of signal that even if inflation stays over 2%, if growth softens just a little bit, we're going to cut rates? I don't think the market will buy it anymore.
I mean, let's just ask the obvious question there. If we were going to see inflationary pressure, regardless of whether it was a Harris, how much are tariffs adding here? And what is your scenario on how inflationary they are?
An impossible question to answer because we have no idea which tariff goes up, which tariff comes down, which stays for like 3 months, 6 months. In a transactional presidency like Trump's, it is impossible to model the impact of tariff on prices because they're not here to stay. They may stay today, they may go away tomorrow. But the fact that we're at a part of the cycle where everybody is sort of aware of their pricing power, which was not the case 8 years ago, and the fact that the economy is at full employment and percolating price pressures are bubbling independent of the tariff means even the slightest hint of tariff would lead to full pass-through of that at the consumer level.
So this is the new cycle we're looking at right now without us knowing it.
Absolutely. It's a different Fed, and it's a super hot economy in the U.S., which might just tip into overheating if all these stimulus measures come through from Trump.
Right. And just to maybe juxtapose the China factor to the global economy then, does China provide a deflationary factor 12 months down the road, or do I get my hopes up that it provides some sort of inflationary factor?
I think it's the latter. I think we've had a lot of deflationary risks work through the Chinese economy. I think on the asset price side, particularly property, I don't think we're going to expect any neutralization of that. But the rest of the economy, having gone through a rather painful correction over the last few years, I think is beginning to show signs of bottoming out. Look at the latest CPI data, look at some of the PPI surveys. It's not like a Japan-style relentless downward manifestation of pressure. It's a rather mixed situation. Parts of the economy rather weak, parts of the economy doing pretty well. Look at the flows of fund coming to the Chinese equity market. Look at the flows of fund in the Hong Kong market for Chinese shares. Global investors have taken note. They find value and interesting things to trade on China. It's not a system-wide buy, but pockets of buy.
On that China call, in terms of, aside from CPI, PPI, you're talking about these green shoots. When is your sort of time frame for when we might see bottoming out in the Chinese economy? And what are some of the other early indicators, alternative metrics that you're looking at?
I'll draw a strong parallel with what happened in the U.S. between 2008 and 2018. U.S. went through painful deleveraging at the household level, at the corporate level, but the stock market did very, very well because of QE and zero interest rate policy. This is the kind of thing I'm looking to see in China. Would the PBOC, instead of just talking about easing policy, really ease policy? With monetary growth, not just at the base money level, but at the broad money level, turn positive in a convincing manner. Once that happens, it's a system-wide buy, not just an episodic buy.
What is a convincing manner? What does that look like? Can you put some numbers? Is it changing the fiscal deficit? How do we think about that?
So both on the fiscal and monetary side. In the fiscal side, I think better targeting as opposed to, because I think the quantum is impressive. It is rather targeting, which is going to be aimed at consumer vouchers that expire, and therefore, if you don't spend the money, you lose the money, so you got to go spend it. That kind of stuff. And on the broad money side, will we see loan growth pick up? Will we see overall deposits, churn taking place, perhaps around this pipeline of IPOs that we're seeing?
So that's interesting then, because you mentioned that Fed might not need to move. China, it seems that what you're saying is we're moving into some sort of QE from the PBOC. Do investors have any business being in the Treasury market? And that seems to be, I just go along on CGBs. Is that a too simplistic way of looking at that trade?
So, David, this is the year for traders. It's just a fantastic year for alpha seekers. I mean, we are way past the beta zone. We're way past the passive investment zone because we have asynchronous monetary policy cycles around the world. BOJ might be tightening. PBOC may be neutral or easing. Fed on the sideline, there might even be a possibility of them capitulating and actually hiking rates at some point if this overheating narrative were to manifest. In a scenario like this, you will find trading opportunities both on the equity and fixed income side within the same yield curve. I may be bearish to 10s. I may be constructive to 10s and 30s. I may think at the very short end, the overnights at 0 to 1 day to 3 months, there are trading opportunities. That would be very different from my CGP trade. So when you say, should we be bearish U.S. fixed income and long Chinese fixed income, I would say there are bearish, bullish options in both yield curves.
The first time around during the trade war, a lot of the countries in Asia, aside from China, of course, were beneficiaries. They were able to benefit from nearshoring and so on. This time around, a lot of those countries, including places like Vietnam that have high fiscal deficits with the US, are under target. How are you assessing economies elsewhere in Asia? Are there any countries where you think there's particular resilience or a narrative around resilience? Who are you worried about?
I live in Singapore. We are going through a golden era of a spike in investment that we've never seen. Malaysia, Singapore are receiving so much money. It's a question of absorbing the flow, and it's all tech-related. Data centers, AI-related modeling, inference, and training centers, chip manufacturers flocking from China, from the US, from Europe, everywhere in the world is flocking to Southeast Asia. That momentum is not going to go away because of the renewed noise around trade war. This region remains vital to the global supply chain. The Americans, for all their bombast, see that. The Chinese, for all their fears about hollowing out, see that. So the region will continue to benefit. I have no doubts in my mind.
Yeah, I mean, it brings my mind back to that report we had on DeepSeek and how they were able to get NVIDIA chips, which was via. Can I make that same extrapolation for India? Like, what's going on with India? Can they get their mojo back this year?
India has a strategy in place. Whether it works out or not, we'll see, but the strategy is very much in place. We've seen that on the fiscal monetary side. RBI cut rates. The budget gave a lot of tax cuts. We're seeing that vis-a-vis the U.S., India totally playing ball with the U.S., bringing back undocumented workers, cutting tariff on Harley-Davidson and other things. So be nice. With China, major thaw in the last 6 to 9 months, from visa issuance to allowing Chinese companies to have JVs in India. You walk around Mumbai or Delhi, MG cars everywhere. I don't think Indians even know that MG is a Chinese car. It's seen as a joint venture between India and China. So India today versus India a year ago, very different as far as this pragmatic approach to trading with China. So nice to China, nice to the U.S., easing monetary policy, easing fiscal policy, strategies in place.
Final question, very quickly. In 10 seconds or so, do we get to parity on the euro this year?
Yes.
Okay. When do you think we'll get there?
It could happen in the next 3 months.
Okay.
The moment we hear the tariffs, the euro will sell off.
Okay. Don't change your money just yet if you're looking to travel in the coming summer. I mean, do it now if you need to. Taimur, fantastic to see you here.
Great to see you.
Taimur Baig there, MD and Chief Global Economist at DBS Bank. Right, about 14 minutes into the cash market session, CSI 300 is down about 0.25%. The bull market continues here in Hong Kong, although we're coming off highs up today. Plenty more ahead. This is Bloomberg. All right, Alibaba, good day yesterday, overnight I mean, well still yesterday if you're watching in the US. Good day today, Baidu's on the way down to the opposite side of this. This report that Alibaba is working with Apple on AI certainly comes as we're looking at this rally in Chinese tech sector, despite President Trump's threats over a trade war. Let's bring in Belle, who's here with us, along with Bloomberg opinion columnist Shuli Ren to talk us through this. Yeah, Belle, I'll start with you. What do we know about this report specifically?
This is a very interesting development, and I think it's good that you point out that Baidu is falling today as well, because it's really this question of who's going to be the partner for Apple in China. We know that Apple wants to roll out Apple Intelligence features. They need to get a local partner in China as well to do that. Last year, the reporting or the thinking around it was maybe Baidu would be their choice. But what the information is reporting is that they've sort of hit a snag in those talks and those developments, and so they've had to turn to a new partner, and it seems like Alibaba now could possibly be that one instead. We're understanding, again, through the information that they've reached a point where they've actually submitted some of this technology to regulators for approval, so it does seem relatively progressed. Of course, you might say, why not DeepSeek, given it's grabbed so much attention? And we do understand, again, from the information that there were some discussions with DeepSeek, but they just felt that they weren't quite mature enough and didn't really have the manpower to really roll this out at scale.
Shuli, I mean, you have this column today about taper, but also the push into Chinese equities again. The tech is obviously a huge part of this story. Just tell us a little bit about what's really, as you see it, going on behind the rally.
So a new investment thesis is emerging after the DeepSeek news. Basically, the idea is that people are becoming aware that basically China is eating the world, outcompeting everyone else, possibly posing existential threats to Western businesses. At some point, that knowledge has to be baked in asset prices, and the investors, at least the more nimble ones, will have to reposition their portfolios ahead of the time. So for some people, they will be like considering this as a short selling opportunity. You know, U.S. companies like dollar stores or whatever, they've been killed by Taimur. So these are the ones that are basically shorting smaller U.S. companies. But some other investors, they are saying, okay, the Chinese companies are so much cheaper than American companies, and they will be dominant at some point, like a BYD, Xiaomi, or even the Pop Mars Labubu, and that they better come in before everyone else rushes in.
I mean, investors have had their hearts broken in the last few years or so, right? To your point, we've had 4 different emotional cycles. Where are we right now in that? If I use that sort of metric.
Yes, it's the Chinese 5 spices. So we have gone through grief, right? Anger, is China investable? Acceptance, we throw in the towel and sell, and the simmer of hope. I think right now they have fear of China, just like President Donald Trump, right? Like people, some fear that Chinese companies are going to kill some Western companies. Some investors fear that they're going to be missing out because their positions in Chinese companies are too light. So I would say this year we see fear.
Okay. I mean, to Shuli's point, Bao, that, you know, some investors may have sort of feel or discussing at the moment they've fundamentally misunderstood China's ability to innovate and how quickly it can innovate. Just lay out how China is making this push into AI, what we might have missed, in fact, as outsiders.
Well, I think it's to Shuli's point, and there is a lot of innovation that goes on in China, and there's a very tight innovation cycle as well. And people would say it's actually much shorter there, that innovation cycle, just given the huge amount of competition. I do think it's interesting just on that point, in terms of the news yesterday that BYD was going to be rolling out its self-driving feature to pretty much all of its vehicle lineup. You saw that sharp reaction in the other Chinese automakers because there's that fear again that BYD has managed to innovate against its peers, and so it does put downward pressure on those other names. But there are sort of broader challenges around AI monetization, and that really comes back to the propensity of people to pay. This is also a tool and a technology that becomes even more commoditized, more standardized, and so you kind of get close to zero pricing as well. Those dynamics come into play. The cloud businesses, I think, at Alibaba and Baidu, they've struggled to gain traction as well a little bit so far. Again, people aren't so willing to pay for these services. It can be a challenge. And also, just lastly, and not to sort of pour any cold water on this, but I do think it's important to note as well that some of the best stories around AI right now, DeepSeek and also ByteDance, they're not companies that are available to public investors either.
Yeah, I mean, they're not. It's difficult to see people making money from them on the language models themselves. But it doesn't mean that AI doesn't have applications that people would be willing to buy into the product, right? And you know, driverless cars, for example, is one example of a product that's really enhanced because of the technology. That takes me into the SMIC story and the earnings which came out yesterday. What does that tell us about this broader AI push here?
Well, it definitely tells you that there is that need for China to have its homegrown champions, and there's that need to find diversified chip supply sources, given that you've got that risk of even further restrictions being placed on companies like NVIDIA being able to export their technology to places like China. And so SMIC, we had net income that undershot a little bit, but still you're seeing that stock rising today, up nearly 3.5% or around that point, and that also points to their outlook for the first quarter, which was a strong outlook. They're maintaining their capex spend from 2024, but it was an aggressive spend, so clearly a lot of investments in this space.
Yeah, and we'll be following that SMIC earnings story later in the show with the Morningstar analyst. That was Bloomberg's tech reporter Annabelle Jewellers and opinion columnist Shuli Ren. Thank you for joining us. There is plenty more ahead. Good morning. This is Bloomberg.
Right, lots of themes across the markets. We haven't even gotten to talk about some of the changes that MSCI has announced to their, well, not just China benchmarks, but also broadly, some of the additions to the China index itself. On your screen, I won't go into detail here. The opposite page is really the deletions coming through as well, mostly to the downside here. Interestingly enough, there's a story out of Meituan, really more with JD.com. Maybe this is market reaction on Meituan, that JD is coming through as far as their food delivery service and now offering zero commission. Might that pose some rethinking as far as the Meituan business model is concerned? And we will leave you with a look at this bubble tea trading debut today, and we are doing okay, I would say. Off highs of the day, still up though. CFO joins us in the next hour of the China Show.
Welcome back and good morning. We are the China Show. It's a little bit of a grey day here in Hong Kong, but really anything but when we're looking at the Hang Seng. We're about half an hour into the session here. Of course, we did see a bit of profit taking yesterday, a little bit of recalibration, but really things bouncing back this morning, Dave. We're just at 1.5%.
Not bad. Not about bad bounce backs. In fact, Morgan Stanley, which tends to, the group largely have a still defensive stance on the markets, but they actually think that this AI-fueled rally can keep going. This is a note out of Laura Wang, of course, we have on our shows. Global investors are starting to reassess China's investability within the tech and AI space after an extended period of limited attention. Just to get that out there as well. And as we look at the board on Alibaba, of course, and the story there is also AI related on this report of this, that it's it's on a Baba and Apple pick and not a Baidu and Apple pick. We're coming off a little bit of the lows here on Baidu. SMIC is also related to the broader theme, of course, out with earnings yesterday. Some news out of the company that it did get a rush of orders coming through. And just the product mix is something that analysts are paying attention to as far as the guidance is concerned as well, right? So, in fact, Morningstar will be joining us this hour to talk us through their take on SMIC. Is it a good company but a bad stock, given how far the stock has actually come up? I think we're up 150%. I'm likely mistaken, but it's something along those lines since about October of last year. Right, the story across markets, broader markets right now is Asia is actually getting a lift from what we're seeing in Hong Kong. Before the Hong Kong Open, it was largely a lethargic headline coming through here, but as you can see right now, we're up 0.25%. S&P futures are flat. The big news, I think, from the emerging narrative from our guests today so far on the Fed, we'll talk about the Fed in a moment, is either the Fed doesn't move at all or they might actually need to consider a rate hike at some point this year. That's based on commentary coming out of State Street and DBS, who joined us in the last hour of the China Show. Just very, very quickly on gold prices, we're seeing a bit of a pullback right now, but make no doubt, 3,000 is a good day, a good week away as we put that milestone very much in our sights here for gold bucks. $80 away per ounce on the most active contract as far as gold is concerned. There we go.
Yeah, Dave, I'm just picking up on your point about the Fed there. Really, we had Federal Reserve Chair Jerome Powell saying overnight the central bank doesn't need to rush to adjust those interest rates, telling Congress they're essentially that, they're going to be patient, that there aren't huge, enormous inflationary pressures right now. And pretty little sort of reaction in the market suggesting that actually this was somewhat within expectations. But to your point, the guess that we had today really suggesting that actually we should be a little bit more cautious, that there might be a bit of a misstep in market calculations here. Anyway, let's just take a listen.
Our stance is actually no rate cuts this year from the Fed, given the fact that the labor market is still strong, the wage data is okay, earnings are still living up to expectations, and then the U.S. growth story or the U.S. exceptionalism story that everybody's talking about, that's still valid. I mean, although equity price actions have been a little weaker year to date, but we still like the story in terms of longing U.S. equities, at least for the levels that we're in right now.
I think that the market is sort of bewildered by the noise coming from Washington and is willing to give benefit of the doubt to the Trump administration that they somehow can go ahead with huge spending cuts, which will match the forthcoming tax cuts, and therefore we shouldn't worry about the fiscal outlook. I think they're dead wrong. I think the U.S. will remain under a lot of fiscal pressure this year, and more importantly, the capacity of the market to absorb that large issuance is very suspect.
Mark Cranfield joins us now for his take really on where we are in the Fed conversation. And Mark, you know how, I think if you take a step back, how the narrative has evolved from, you know, we're going to cut by this much, we're going to pause, and maybe we might hike if you just take a sort of pulse check randomly across the last 6 months or so. Where do you think the risk is for markets at this point?
Well, one thing I don't think anybody expects to hear come out of Jerome Powell's mouth is we're about to hike. Those are words which he will very carefully avoid saying, given the circumstances about who his current boss is. However, he will continue to draw a very neutral line right down the center for as long as he possibly can. The Fed are in an interesting situation here. They've lowered interest rates to some extent. Inflation has come down pretty close to the target level they wanted to, but they're now in a new world where they're waiting to see how new policies coming out of the White House will affect especially the inflation outlook. And we get inflation numbers later today. That gives us a first look. But it's probably a bit early in the series really to get anything meaningful. We'll have to wait a little while. Traders are certainly coming around to the view that the Fed could be on hold for quite a long time. At one stage, we had something like 3 interest rate cuts priced into the market. Now we've only got just over 1 interest rate cut priced in, and not until September anyway. So it could well be that over the next couple of months we see that dialed back even further to the point where traders don't expect rates to go either way. For the Fed to actually hike interest rates in this situation would be extreme. There would need to be massive move in inflation expectations and the actual data itself. Most likely what we're going to have to get used to is very cautious language from Fed speakers and officials, especially from the chairman himself, and the Fed staying on hold for quite an extended period. They may well be able to get through the whole year without changing interest rates, but as they always say, they're very data dependent, and this time around the data is going to be much more harder to predict, depending on whether we get a big trade war, whether we get big changes out of the White House in terms of policy. It's a much more fluid situation than it has been for some time, but the Fed on hold looks like it's going to be there for some time.
Mark, we don't often talk about individual names with you, but I do want to ask about CATL. I mean, it's a firm that really needs no introduction, but potentially coming to the Hong Kong market with a $5 billion US listing. What do you make of this? And is it an important sort of test, given, of course, that CATL is on this Pentagon list of firms with alleged links to the Chinese military?
This is a big enough equity issue to have really wide implications for the whole Hong Kong market here. It's going to be pretty exciting when they come. And you'd have to think they want to get this issue out the way as quickly as possible. There is the risk that a tariff war will be coming. It's pretty unpredictable. If you're a major company, you've seen a very good start to the year, especially for Chinese tech names. They've done extremely well in the Hong Kong market and onshore as well. So if you're CATL, you probably want to get this IPO out the way while the market is relatively hot. Now, it's such a big IPO that it, in a way, is a little bit destructive for the market, because fund managers need to set aside quite a lot of their money. Now, imagine what happens here. We've seen before in Hong Kong where huge amounts of money can get sucked in during the book building process. Sometimes IPOs are massively oversubscribed in Hong Kong. Now, that has repercussions for the Hong Kong dollar money market. We've seen before how short-term interest rates can be squeezed up because so much money goes into a single IPO. CATL certainly has the possibility of doing that. It may also push the Hong Kong dollar as well as people rush to get their allocations in. It's going to be a very interesting period. The minute they officially announce that the books are open, just watch the knock-on effects across Hong Kong dollar markets, across the whole equity market, across the region probably. It is a very big deal. And traders, not only in equities, need to keep their eye on what's going on there.
OK, Bloomberg's M-Live strategist, Mark Cranfield, telling us to keep our eyes open, stay alert, stay awake. Thank you, Mark. And just turning to some of the breaking news crossing my desk this morning, Hon Hai has met with Honda and Nissan. So the Hon Hai chairman, Young Liu, saying that in Taipei will continue following that story. Yeah, we'll get more on that in just a moment.
Yeah, in the meantime, though, let's turn our attention to the other big story, Trump, tariffs, Elon Musk, with President Trump directing agencies to comply with Elon Musk's government cost-cutting effort to slash their workforces. Now, Trump's action came as Musk visited the Oval Office to defend his approach, including access to sensitive computer systems and employee data. Let's bring in Derek Wolbank, our senior editor, to joins us right now to talk us through the how much reduction are we looking at here, potentially, in some of these headcount here?
Well, David, we need to be a little bit careful on how much it might wind up being, because there have been estimates of how much Elon Musk's Doge effort would cut from the federal government, and so far those have a little bit underwhelmed. Musk had originally set a target for 5 to 10% of the federal workforce, taking his early retirement option, I guess you could call it, with a somewhat of a buyout paid through the end of the fiscal year, which is end of September. But that ran into a certain amount of problems, both legal problems as well as they just didn't have as many people signing up as they wanted to. Now, Trump is going forward telling federal agencies to comply with Doge, to help them out, to not stand in their way. They're talking now about a possible option to maybe be allowed to hire one person for every 4 who are gone, still sort of targeting this idea that agencies are going to be smaller, they're going to have fewer buildings, they're going to have fewer people. Those who remain will be having to come in 5 days a week, hoping that some additional restrictions will maybe lead to additional attrition, and that will pull down the size of the federal workforce. But it's all a little bit in the mix right now. One thing that I thought was really important that came out of that back and forth is that they did admit that they're going to have to go to Congress for a fair amount of authorization on this. That's something that Democrats have been screaming about, and it really does raise a question because Republicans do control the House and the Senate, but only thinly, and it's going to be incredibly difficult to pass some of the legislation that's going to be required to put in some of these tougher cuts that Trump wants to do.
Derek, we also had these comments from the Citadel founder Ken Griffin overnight, commenting and thanking Elon Musk for some of the work he's doing, also criticizing President Trump on some of the rhetoric around the tariffs, for example, but praising the plans around the Middle East. I just want to ask about sort of the kind of discourse and the shift in discourse and dialogue that we're seeing from, really significant senior businessmen in that landscape. What role is that playing when it comes to policy making? How significant is this sort of interaction, particularly when we think about, I guess, the dynamic between Elon and Trump here too?
Rebecca, I think it's huge, and I think it's huge on both sides, right? Trump is somebody who, look, let's remember, he is a Queens guy who always grew up looking across the river to Manhattan, right? Finally made it big in Manhattan, but the idea of these sort of business titans now being people who want his ear is something that's very appealing to the president. At the same time, these companies are trying to figure out a strategy, just like world leaders across the globe are trying to figure out a strategy for how to deal with Trump. It's very clear right now that Trump is, and if you're using like a scientific concept, think of there's a substance called oobleck where like if you hit it hard, it's very resistant. But if you just sort of press a little bit, it's a little bit malleable. The strategy for dealing with Trump somewhat resembles that. If you don't know what I'm talking about, go watch a Mark Rober video on YouTube. You'll see what I'm talking about. But that's kind of the idea. You have seen some of these CEOs try and cozy up to Trump a little bit. Mark Zuckerberg is one. Tim Cook is another. TikTok has very much done this. You've also seen some countries do the same thing, and you've seen some of them, Japan I'm thinking of, India I'm thinking of, have maybe a little bit more success than the ones who have come straight back at Trump with a counterpunch like, say, Canada. And so I think this is going to be one of those key dynamics that we're watching all the time. Even when CEOs are trying to say to this White House, we think that what you're doing is really bad or really dumb or is going to have big consequences you're not thinking about that are going to be terrible, they may not do it in a straight bat sort of way. They may do it in a little bit of a round the corner kind of way because that might be the thing that works better in this context. But this is something everyone is trying to find out. As I say, it really does go both ways. It's a great question.
Derek, thank you so much. Derek Wallbank, there, a senior editor on all the latest out of Washington and some really key context there. All right. Check this out. All right. So the Hon Hai news that we talked about earlier on, and that line coming through that it spoke, it was, okay, let me just get the exact line. So I'm not going to paraphrase it here. Hon Hai has met with Honda and Nissan. So when that headline dropped, this happened on the stock price. You'll see it coming up shortly on your screens. On the way up, just remember, right? This is a name that was really part of the broader conversations around this potential. Not this, guys. Can we get the intraday up, please, if we can, because we want to show really when that news took place. And there we go. We're now up on the stock. Honda's actually down 1%. Can we get that up, please? If we can. We had it up earlier on. And now we're looking at Hon Hai saying it could consider buying Renault stake over in Nissan. There we go. That spike towards the right side of your screens is when that news broke. We'll keep on top of the story. And on top of that, too, the bull market has resumed after that brief pause on Tuesday. Stocks are up. Do we have the benchmarks up, please? Chinese benchmarks? We'll show it to you later. Anyway, we'll talk about property next.
Yeah, I mean, shifting gears a little bit, just taking a bit of a step back this morning, we're looking at the property crisis that's hobbled the Chinese economy and created a near $160 billion pile of distressed debt that is just getting worse. Well, we're covering more on that and on China's struggling property sector in our big take next. Now, Moody's has cut China Vanke's credit rating deeper into junk territory, just as the developer is grappling with mounting losses. Moody's says the outlook remains negative, implying the possibility of another near-term downgrade. Now, China Vanke really has found itself at the center of a property crisis that's worsening at a wrong time. That is the subject of today's Big Take. For more, let's bring in China credit reporter Loretta Chen, who really has been across this story for a long time now, following every twist and turn. But just to take a step back, why is Vanke so important when we think about where we are in the cycle of the property crisis and distress in China?
Yeah, Vanke is a household name. When the beginning of the property crisis really started, you're seeing names like Evergrande, Country Garden, the property developers that really expended excessively and borrowed excessively, that really fall into that pile of distress. But nobody ever thought Vanke would be impacted because, you know, on balance sheet, it's managed its debt really well. It's got the government support with Shenzhen Metro as one of its major shareholders. So these factors really played in the early stages of the property crisis, kind of convincing people that if you have kind of state background, if you didn't borrow as much as Evergrande back in the days, you would be okay. But it seems like the worsening property crisis has really engulfed into players like Vanke.
And it does feel like, in a way, we've been talking about this for sort of 3 years here, these names that are perhaps too big to fail, the idea that the state may come in and be forced to kind of provide some kind of support. Vanke is different in that it has actually happened. How is that affecting contagion risk when we think about, you know, how some of this stress is passing on even to some of the stronger China and Hong Kong property developers?
Yeah, I think it remains to be seen, you know, whether the government really knows if it is to support Vanke, you know, how it's going to do that. Just yesterday, we're seeing Shenzhen Metro actually has the first time provided loans to Vanke, which is a 2.8 billion yuan, which is not a big amount, but you know, in the short term, it could help address some of these liquidity blocks at the company. But Shenzhen Metro, keep in mind, even if it's a state-owned entity, it is not a profit-making entity in Shenzhen, so it cannot, you know, keep on providing these low interest rate loans to Vanke. Eventually, you need the market to recover. You need Vanke to keep selling these homes for the company to eventually turn around these liquidity issues.
Yeah, sales really at the fundamental sort of basis and origin of this story here. That's Bloomberg's China credit reporter Loretta Chen there. And terminal subscribers can get more on this using the function NI Big Take. Please take a look. It's an excellent story. Lots of strong reporting in there. The story is also up in full on Bloomberg.com. There's plenty more ahead. Stay with us. This is Bloomberg. Good morning. You are watching the China Show. We are looking at OpenAI CEO Sam Altman. He's saying a $97 billion takeover offer led by Elon Musk is a business strategy that comes from a position of insecurity. Altman told us he remains confident in his company's technology and strategy despite the disruption from China's DeepSeek and the Musk bid.
OpenAI is not for sale. The OpenAI mission is not for sale. Elon tries all sorts of things for a long time. This is this week's episode.
You take it seriously at all? What do you think he's trying to drive at with this?
I think he's probably just trying to slow us down. He obviously is a competitor. He's working hard and has raised a lot of money for XAI, and they're trying to compete with us from a technological perspective, from getting the product into the market. And I wish he would just compete by building a better product, but I think there's been a lot of tactics, many lawsuits, all sorts of other crazy stuff, now this. And we'll try to just put our head down and keep working. Does it make it more difficult to move from that non-profit model to that for-profit model for OpenAI? We're not moving to a for-profit model. We're not sure we're going to do it all, but no matter what, the nonprofit will continue to be extremely important. It will drive the mission. It will continue to exist. The board is looking at lots of options about how to best structure for this next phase, but the nonprofit is not changing into anything or going anywhere. And have you had clarity on DeepSeek? I know you and the team have been looking into that, whether they distilled, whether they inappropriately used your inferencing data. Have you had more clarity on that? Whether they did or didn't,
they a challenge,
they
a threat?
Built a good model. Many people will distill from many other models. Again, I feel so confident about our research roadmap and also our product roadmap that, DeepSeek will do whatever DeepSeek's going to do. Other people do whatever they're going to do. And we're just going to try to build the best technology we can and get it into people's hands. And I think that's mostly going pretty well. Do you think Musk's approach then is from a position of insecurity about XAI? Probably his whole life is from a position of insecurity. I feel for the guy. You feel for him? I do, actually. I don't think he's a happy person. I do feel for him. Okay. Do you worry that he has this proximity to the president and he can influence the decision-making of the US presidency and policies around this agenda on AI? Not particularly. Maybe I should, but not particularly. I try to just wake up and think about how we're going to make our technology better.
What a star. Yeah, Sam Altman there with our Tom McKenzie at the Paris AI Action Summit. Right. So, what a perfect segue going into really the China market story of the day. This really AI conversation around fine. It was DeepSeek, and then there's the Alibaba story, and then there's the Alibaba Apple story to combine that too. So, right, the Alibaba and Alibaba related shares, as you can see, are gaining substantially about an hour into the cash market session. Right. So at 113.30 right now, where does this put sort of Alibaba relative to the high that we hit back in October? We're going to show that we're very, very close to that peak in early October. In fact, a little bit more. I think we're just about a good or 2 days away from that. The 6-month chart, please, can we get that up? Thank you so much. And as you can see, there we are. That's where we were. Now, you take a bigger step back in 5 years. If you're a bull and have been, kept your exposure, you might want to close your eyes right now. But just to give you really some context on that's where we are, that's where we were. Right. So we'll keep on top of the story, but certainly it's a massive rally taking place right now. Meng, trading debut in Hong Kong, bubble tea maker, up 8 cents of 1%. We'll be speaking with the CFO in a couple of minutes, what they plan to do with that money and what the plans are ahead for the company. Keep it here.
Good morning. It's 11:29 a.m. in Tokyo. Japanese markets about to go on a break for their lunch. Just taking a look at markets there. Yep, well, we're a touch high on the Nikkei, touch down on the topics, relatively unchanged compared to, say, Dave, what we're seeing in the Hong Kong markets, where we are having a rally, really a tech-driven rally.
It has been a fantastic. It's Feb 12, which almost puts us almost exactly a month back when the rally, when that was the bottom on the Hang Seng Tech Index, and we're up, 23% on the benchmark there. And you know what? 2 days away from Valentine's Day. Not sure that's a reference at this point in time. Maybe get your loved one something nice and something sweet. There we go.
About presents already?
Bubble tea.
Okay.
She loves that.
It's a perfect segue.
It's also not very expensive, and there's a ton of them out there. On the streets of Hong Kong. In fact, just on that very note, there we go. Meng Holdings, slightly to the upside here, $9.94, I believe, was the IPO price. Raised quite a bit of money right now. And yeah, this is certainly an expanding market, crowded market, question mark. And what does it mean for the future as far as corporate strategy is concerned? Joining us here, in fact, on set, is the company's CFO, George Meng, who is with us to talk us through what you guys plan to do with the money. Good morning, by the way. Nice to see you.
Good morning. Thank you very much.
So what's how long does this cover you for, the money that you guys raised?
Well, actually, we don't really need the money to raise. So if you look at our prospectus, we're going to distribute 2 billion RMB for the special dividend after the IPO to the post-IPO shareholders. Okay. But we also distribute about 1.7. So in total, we actually are going to distribute 3.7 billion RMB, but we're only raising like 1.5 billion. So you can see we're actually on a net basis, we're distributing more than what we raise. Yeah. So it's really not about the money.
Okay.
Yeah.
One key part of your strategy of more than 10,000 stores, but has really been about expanding into second-tier, lower-tier cities, into the hinterland, really, really aggressively. I'm just wondering, are you planning to expand also now into top-tier cities, into a Shanghai or Beijing? What's the strategy, and do you have a target amount of stores that you want to open by the end of this year?
Yeah, definitely. So we were born in those low-tier cities, or basically it's not even cities, it's towns and townships, and then we gradually we also entered places like Hangzhou, and then we will be in Shanghai and Beijing. We are already actually in Shenzhen and Guangzhou, so the so-called first-tier city. So it's just we are going to be everywhere in China, but then the top priority for us today is still the so-called lower-tier cities or the towns, the counties, places like that. Yeah, so we're not in a hurry to go to places like Beijing and Shanghai because there are already plenty of bubble tea shops there, and we don't really think our competitive advantage in those places as high as we are in those low-tier places.
What about your expansion into overseas markets? Plan to kind of be as aggressive in that space as well?
No, actually, we don't have any tangible plan to go to overseas market, and at least not in the next 2 years. And by the way, we are not really that aggressive. If you look at our expansion, right, it's quite steady over the years. So maybe if you check the other players in the past 5 to 10 years, a lot of people double their stores, triple their stores in a single year, but we never did that, right? It's only about 20%, 30%. So we're very steady, and what we call a regional densification strategy, where if you look at the map that of China, we were only in half of the places in China. So it's still, we do have a lot of white space or low-hanging fruit for us to grab. Yeah.
What's your annual projection for revenue growth?
Yeah, so for the next 3 to 5 years, we were looking at anywhere between 20 to 30%, and to be conservative.
Okay.
But on the other hand, if we touch on valuation,
sure.
Yeah. So if you think about dividend yield for that special dividend, you get almost 10% dividend yield. But even after that special dividend, which people think it's a one-off, we actually wrote in our prospectus we're going to distribute no less than 50% of our annual profit. And considering that we are not a very asset-heavy model, in essence or in reality, we can actually distribute more than that. So let's say 80%. So if you put that into the equation, you will definitely get about anywhere 7% or so of dividend yield.
Right.
So we're a yield stock, but then we also give you like 20-30% growth.
The question then becomes, I guess, obviously for investors, that's a good thing that you're giving money back immediately. Do you get the question of why don't you just use that money to grow more aggressively, for example? And what is the answer to that question?
Yeah, I think if you look at our business model, right, it's a franchise model. So it's really not us that put a lot of money to drive that kind of expansion. So if you are direct operated model, then you do need to put a lot of capex on store expansion. Right. In our model, it's not, right? So it's really the question that how do you keep the profitability of your franchisees? It's very easy for all these headquarters. If you look at the list of the issuers, some of the issuers that operate on the same model, you'll realize that they decline on same store, or some of their franchisees are closing their stores. But again, if you look at the financials of the headquarter, what we see is like something above the water. Everybody is making nice profit, but that's not kind of sustainable if you don't make your franchisees make sustainable profits.
You've mentioned that you didn't really necessarily need the money.
Yeah.
You're also coming into a Hong Kong IPO market that's been quite sluggish. It's been not that friendly to newcomers.
Right.
So why come now?
Oh, so we never tried to time the market. So I joined the company like 5 years ago. And even at that point, we're saying maybe 2023, 2024 kind of time horizon. And now I think starting from the year before, we have the CSRC approval thing. So, that takes some time, and because there were so many companies in that queue. But now we have that kind of approval, so we just go ahead. We really don't think that we can always time the best market, right? It's so hard to do so. So we just want to get this thing, behind us and go back to do our own work. Yeah.
Yeah. And you mentioned that you get a lot of questions around competition, and you're not too worried about competition. You were born
in competition.
In competition, right? Diamond sharpens diamond, right? As they say. So what sets you guys apart? So why would I say, as a franchisor, why would I franchise with you and not say your competitor?
Yeah. So if you think about franchisees' profile, when we look for a very different type of franchisees. Some of the other players, they look for very big franchisees who have financial resources, who have resources of site selection, things like that. We are actually looking for, small franchisees, small mom and pops, and, they are willing to invest not their money, but their time, their effort, their labor into the business. So that's the kind of franchisees that we are looking for, which is very different from other people. So, we're not looking after the same group of people. But talking about differentiation, it's very interesting. Last time, so about a year ago, when we first do our first round of test of water, and I think at least 70% of the investor asked the same question: what's the difference between you and some player A or player B or some of the listed issuers? But I think this time around, much less people asked about that question, because if you look at the evolution of this industry, a lot of people, they grow into different profiles, like almost naturally. I guess my hypothesis is that, if some people looks very much like us, like Wumi, they are outcompeted by us, and then they will maybe go out of business sooner or later. So if you think about the survivors or the top players today, they look quite unlike each other, right? So at the end of the day, it will be, if you think about some of the big names, right, Mixue, obviously a bigger name than us, and then you have Luckin, which is coffee, but nowadays
somewhat related. There's an overlap there.
Yeah, there's a much bigger overlap going forward. So, but everybody has their own. Not really a niche, but then you do have something that you are very good at. So at the end of the day, it's not about what people call a homogeneous competition, right? It's still, everybody grows into a different profile naturally, almost like a natural selection thing. Yeah.
I mean, we've seen some sluggishness in consumer demand and sentiment really dragging on the economy in China. I want to ask what your outlook is for the consumer in China, but particularly, I guess, the profile of the consumer that is buying your product.
Yeah. I mean, traditionally, people think that people in the high-tier cities are willing to pay a high price or they have more spending power, but it was not the case because in lower tier, in towns and townships, they don't have the pressure to buy a house or you don't spend a lot on housing. So actually, their disposable income were actually much higher than in top-tier cities. And we believe it will continue to be the case. But in any case, we are not going to project where the economy is going. So we're not going to project the beta. But what we are looking for, at least in the past 3 to 5 years, we will consistently deliver a alpha over that beta, over that industry average.
Where do you suspect pricing trends go? And I want to understand too, at the same time, in an industry where, correct me if I'm wrong, it doesn't seem like switching costs are that high. I simply have to walk next door.
Right.
What is elasticity of demand for your product?
Yeah, that's a very good question. When you talk about elasticity, you have an assumption that the product are similar.
Right.
But now we believe the product are very different, and especially it may look, let's say, similar on the surface. But that's our strategy. When everybody else are cutting their price, we maintain the price, but in the same time, we're going to increase the quality of our product. So that's our strategy. So if you think about, if you look at the data, our ASP didn't decrease last year. It actually increased a little bit last year. Yeah.
And has quantity then responded in a way that's favorable, that you thought was favorable, or did you?
We also maintain flattish kind of quantity. Of course, we changed some strategy on the third-party platforms, but we focused on our own channel.
Yep.
So there's a mixed change there. But I guess the big question is about the outlook of the industry and the outlook of spending. I think that last Sunday we saw this big Hong Kong marathon, right? It's really like a marathon race where everybody is going there for at least 42 kilometers, and then you don't need to sprint, in the first half. And if you look at some of the elite runners, right, almost a lot of people have this better second half than the first half, right? So you have to. Yeah, you have to pace your own, running. So it's the same thing. So we believe, we don't need to be very fast initially, but the longevity, the stamina, the endurance is more important.
Dave, by the way, is training for a marathon right now, so he understands that world of pain. Just keep your head in the game.
Don't remind me of my other job.
Okay, talking about endurance, long-term plans. I mean, your stake in the company is worth about 1.2 billion at that IPO price. I want to ask, really, what's next for you? What's your next venture? Do you have another venture after the bubble tea industry? Yeah,
I think, definitely. But today we're still very small. We're almost still like an original player. So it's really, we have some plans for let's so-called second curve or something. But today, the first curve is still, we have still plenty of room there. Interestingly, we are going to celebrate our 15th anniversary this coming April. So it's April the 1st.
Right.
And so in that sense, we were born a fool, and we intend to keep that way. And, stay foolish, stay sometimes hungry, but don't stay thirsty, right? Stay hydrated. So no matter coffee or tea, always good me. Yeah, try.
And I wonder how you see the product evolving longer term, because I can think of the analogy of the convenience store. When everyone said there was, and just to borrow an example, this 7-Eleven looks too close to that 7-Eleven,
right.
But then they seem to coexist.
Yeah.
Do you think that's where, we call it bubble tea now, but do you think the concept evolves that it seems that things are getting saturated, but they're really not? Is that where you, and why do you think that is?
Yeah, so if you look at on the demand side, people have this misconception last year that the industry is no longer growing, so it's all about so-called involution or irrational competition, but it's not the case. Even on the demand side, it still grows about 10% or even higher last year in a very hard environment. And if you look at the demographics of Chinese consumers, contrary to many people's belief, although the birth rate is no longer longer growing or it's actually declining. But if you look at our consumer base, if you look at so-called bubble tea population, you will see that's still expanding because people at their 40s, 50s, they don't drink bubble tea in the first place, right? And if you look at the millennials or even, people, like even for the zero age, maybe less than 10 million people, but again, I assume 90%, if not 100% of them drink bubble tea or tea, freshly made tea drinks or coffee.
George, thank you so much for joining us. And just to clarify, it's founder Wang's stake that is at 1.2 billion at that IPO price. Guming CFO George Meng joining us there. And if you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function, TV Go. You can also join the conversation by sending instant messages to our team and our guests during the live show. Go check it out at TV Go. Stay with us. This is The China Show.
Welcome back. You're watching The China Show. SMIC out with earnings yesterday, some guidance, and also some news this morning. I missed an estimates, but guidance was, if you base it on so far what the street's been saying, fairly encouraging as far as demand goes for the company. Let's bring in Phelix Lee, equity analyst at Morningstar. He covers SMIC, of course, among others. Phelix, just your key takeaways. Let's start there.
Right. So, to start off with SMIC's earnings, the revenue and the gross margin guidance is a bit above consensus. But what we would really look at is the CapEx guidance. So the company is budgeting about 7 to 7.5 billion CapEx in 2025. So that is higher than what we were expecting a few months ago, which was about 5 billion. So we think this could this is actually a sign of confidence by management that they will be able to address new demands in automotive, industrials, and the recent China subsidies on electronics is also another short-term tailwind for the company. So all in all, it's a pretty good earnings report, at least in terms of the guidance. So that's my initial take on the earnings.
Phelix, Rebecca here. I just want to ask you about your outlook when it comes to tariffs on the semiconductor industry. How quickly SMIC is finding itself able to sort of pivot to self-sufficiency.
Right. So to start off with revenue, so the company has only around 20 to 30% sales coming from outside China. So even if the tariff, when the tariff hits, I think only this 20 to 30% would be directly affected. And then the other thing is that SMIC is also one of the main beneficiaries of the localization drive. So we would expect the proportion of China revenue would be increasing in the coming quarters as well. And this kind of domestic increase in terms of contribution would also apply to many of the other Chinese names in our coverage.
Right. And Phelix, how visible are earnings beyond the next 2 years?
Well, basically, the company has, some sort of capacity growth plan. So we have a very high visibility on the supply side. What is the difficult part of forecasting is the demand side, because we sometimes see inventory corrections in the middle or towards the end of the year. Sometimes you would have demand shocks when let's say if smartphones don't upgrade, then there will be a temporary slowdown in demand. So we would have a high degree of confidence for the next 2 quarters or so, a moderate confidence in a year or two. But, as we go beyond 2 years, it would be a bit more hazy in terms of demand.
Phelix, I want to ask about the impact of DeepSeek. We have seen a recalibration across markets from investors and how they evaluate essentially China's ability to innovate and its innovation cycle. I mean, how significant is this for the semiconductor industry? And I suppose for Chinese names in particular, is this something that's already a known factor, already a known sort of beneficiary?
Right. So DeepSeek, what DeepSeek enables is to essentially allow some simplified models or distilled models to be available to Chinese companies. So these Chinese companies can build on what DeepSeek has into smaller and easier to commercialize models. And these models typically would require less computing power. So this, in order to benefit SMIC and the other Chinese names, what they can do is to have, small and, small, less powerful, but still reasonably power efficient computing chips. So this part of the demand is where SMIC and other Chinese names can cater to. In addition, they also, these AI models, apart from computing chips, they would also need power management chips and possibly connectivity chips. So all these, supporting chips other than the computing chip is also addressable by, SMIC and the Chinese players.
Phelix, not more than 6 months ago, the share price was trading at about 15. It's now at nearly 50. While the outlook for the company looks decent, what do you think of the stock?
So we do have a 1-star rating on the stock, which is our lowest rating in the Morningstar methodology. The reason why we have this lowest rating is because we think the company is very likely to have negative cash flow, in the next 3 to 5 years. So based on some initial calculation, the company has around 8 billion revenue in 2024, and it's likely to add about 1 to 2 billion each year. And then the company would spend about $7 billion in capex. So based on these numbers, we can quite confidently say that SMIC, if it maintains its capital spending, it's very unlikely to be cash flow positive. So this is the key reason why we have this rating on the stock.
Phelix Lee, equity analyst at Morningstar Asia. Thank you for joining us. Now, stay with us. There is plenty more ahead. You're watching The China Show.
Right, a check of some of the big movers, as you can see. In fact, when you look at it on a technical basis, Alibaba may be hitting its head right now on some of these, I guess, overheating signals coming through in the market. I mean, 86 on the RSI. But that being said, of course, that also underscores momentum really is behind this rally. 8% to the upside, just a sliver away from the October highs. And that's, as you can see, it's playing out across some of the other big names, including some of the Apple-related suppliers on the back of maybe that Alibaba-Apple story here.
Yeah, I mean, this tech rally just really got underway, hard to retreat. Thinking also about Hon Hai today, this potential deal in the works now. Hon Hai could be considering, or it could consider buying a Renault stake in Nissan. Everything a little bit down on the downside. Yeah, Nissan down 6.8 now.
It's getting a bit complicated as far as this complex potential deal was concerned. It looks like it was falling to the cracks, and then we have this additional piece of information. More on this, of course, later on. In the meantime, as Rebecca was pointing out, we're still in the early innings, according to, if you go by Morgan Stanley's note, that people are starting to realize this AI opportunity in Chinese equity markets. 2% as we move into the last 60 minutes of the morning session here in Hong Kong.